welcome to the CNBC TV18 Investment Guide. I'm Surabhi Upadhyay. Has COVID permanently changed the way in which we consume, how we are going to buy things, what we need, our travel patterns, our spending patterns? If that's the case, then are businesses in the consumer sector seeing permanent disruption? Will there be new leaders? And if all of this is worth thinking about, then you also need to think about how you will invest in the consumer sector. What should the approach be in the post-COVID world? That's what we're discussing, and we have two experts to help us decipher some of these issues. Joining in is Abneesh Roy, who's tracked the consumer story of India for many, many years. He's the Vice President at Edelweiss Institutional Equities. And also with us is Sonam Udasi, Senior Fund Manager at Tata Mutual Fund, who among other funds also looks at Tata's consumption fund, the Tata India Consumer Fund. Thank you very much, gentlemen, for joining us on the show. And it's going to be great to hear some perspective from you. So the first basic question, Sonam, to you, are we seeing a big disruption? Is COVID really changing things for good?
I think there are two key changes. One is, of course, the consumer behavior, where, the focus is buying essential. And keeping discretion on the back burner for now. But the bigger, I think, change, which is, I think, more sticky, is how, the companies are looking at this. We were anyway going digital, and this space has picked up. So the companies are not, whether you're a big company or a small company, it doesn't matter. You have to have an online presence, have to have an e-commerce strategy. And you have to have the ability to talk to not only the customer online, but to also have your supply chain, which is digitized, where you can have real-time inventory, sense of what's moving fast and what's not, and how do you change that very, very rapidly. So it's becoming smarter, and it's here to stay.
Okay, that's an important point as well. Yes, absolutely. Digital technology has had a huge role to play in the way we are accessing services and products. And that's something we'll talk about as we go forward as well. Abneesh, opening to our thoughts with you as well. I think, when it comes to consumer stocks, everyone's trying to figure out which are the companies that can see outsized growth as we get through COVID and get over COVID. And which are the ones that could perhaps see, maybe a permanent loss of demand or at least permanent disruption? Your thoughts?
Sure. Thanks. Good afternoon to everyone. So I think pent-up demand will be there. In wave one also, we saw many discretionary segments saw pent-up demand. So I think that will again happen this time. Of course, there are further nuances here. If you remember wave one, we saw paints, adhesives, waterproofing, jewelry, QSR, home decor, etc. do exceedingly well. My sense is in wave two, we will see a recurrence of that. Over and above that, multiplexes should do really well, because as most of the urban India is getting vaccinated, and we also have hopefully a lot more herd immunity than earlier, plus international box office has opened up, which is, I think, a key criteria for Hindi movie release, which did not happen in wave one. So I would expect the multiplexes also to get added there. Permanent disruption definitely will be there. Retailers who have very little private label, for example, plus have very low e-commerce, I think they will really suffer even when things become a bit more normalized. For FMCG companies, I think rural demand has got a bit derailed because of the wave two. I would expect that to come back because of very good monsoon. So I would say there are multiple themes to play even in wave two in the next 2-3 quarters time frame. Yes.
Okay, it's really interesting that you're positive on the cinema stocks, because that's where the big debate was, that whether there is permanent disruption there, whether OTT is really the new way to go. But that's an interesting view. Sonam, come in on this and also expand on that point that you made on digital. How is that likely going to, let's say, shape your thoughts as a stock picker, as a fund manager, and what is your take on discretionary consumption? What would you pick? What would what's a strict no-go for you?
So I think it is very, very important. See, India is a very young nation, and most of the youth now, whether you are a tier 3 guy or a tier 4 guy, it doesn't matter. You are aspirational. You have to have that kind of connect with the youth on the digital platforms. So any theme that is not talking to you online, you need to have that. So whether it's online aggregators on restaurants, whether it's QSR, whether it's actually searching of jobs online or online ticketing, those are all important aspects to have. And there are companies who are creating brands only for online space. So we are excited by that. These are very fast-paced growth segments. Penetration levels are low. Ultimately, per capita, it's a play on rising per capita income. So if per capita income, which is sub $1,500 for India today, and in next 7 years we are going to double, anything that is aspirational and is talking to the youth is the segment that we would want to look at.
Okay, just to follow up, Sonam, on this, you mentioned the online model. Now, in the listed space, there aren't too many of these plays available. I mean, you have the quasi-digital tech companies or maybe something like an InfoEdge. But how else are you looking to sort of distill down to the listed universe some of the points that you just made?
So there are, fortunately, there are 4 or 5, companies that we can look at that way. But more importantly, even on the listed space, which we call the traditional FMCG or discretionary companies, all of them have a digital strategy. All of them have either products that are aligned to that, class of customer, or are, trying to find efficiency through their backend by having this digital strategy. So it gives you a moat on profitability as well. It keeps your costs under control. It makes you what we call TAT. Your response time to customer is very, very fast. So any model that is looking to that, any company which has a strategy around that, that is what we are excited by. There are many things to look at really within this.
Okay, that's really interesting. Gives us a peek into Sonam's mind. He's looking for consumer companies that can leverage technology really well, whether it's to reach their customers, whether sort of product innovation and things like that. Abneesh, so now let's map this with what's happening on the discretionary side. And my question is very simple. Will the old stars, the Page Industries of the world, will they really make a comeback? You've already made a strong case for the cinema stocks. I'm guessing PVR is something you like. What else? I mean, QSRs, look at Jubilant FoodWorks. It's just dominated everything else. And then there are a lot of new listings in QSRs. Do you find enough sense and value there?
Yes, definitely. QSR is extremely interesting because customers focus on trust plus on healthy products will continue and will become even stronger. Plus, there has been a huge market share gains against the unorganized because they have gone through much higher impact because of wave 1 and wave 2, while QSRs were very quick to adapt and take e-commerce and home delivery to the next level. We will have a Page much lower in terms of taking order because the competitive intensity is definitely there from Aditya Birla Fashion and other players. Page is doing a commendable job. But on current valuation and the risk from competition, we'll prefer QSRs, we'll prefer PVR and Inox both. We also like Titan a lot. If you remember in wave 1, the company which bounced back the first was Titan because expensive marriages are not happening because of the restrictions. Plus overseas trips are not happening. So we are social beings, so we will need to enjoy. So what we are seeing is definitely much higher outlay toward jewelry is happening. Gold prices have also done well. So Titan, QSR and multiplexes in discretionary plus paint, Asian Paint. These are the 4 or 5 stocks which we really like in the discretionary consumption.
Okay. You mentioned the valuation word. That's always a tricky game when it comes to consumer. Now, Sonam, let's talk valuations on the discretionary side of it itself. We'll come to staples in a minute. How do you look at the price on the screen versus the opportunity and break it up for us? I mean, you can talk autos. We haven't discussed the entire the building materials part of it, or maybe consumer durables, consumer appliances. What still looks comfortable to you over here?
The one thing is very, very clear. Segments in discretion like consumer appliances, penetration levels are, not so great. I mean, some of the segments are sub 20% penetration as compared to staples where soaps is like 100% penetration. So you can really double penetration in the next 5-7 years, and you have a long runway for growth. So valuations, no doubt, I can't call them cheap, but the nature of the industry, and there are winners here. I mean, very good companies, very well managed companies, very good brands, scope to grow, scope to double size. To that extent, you will have to pay a premium to sort of own these spaces. The panelist on the other side mentioned building products and paints. That too, penetration, the kind of volume momentum that can come in. Government capex has picked up. Real estate is coming back. These are also short-term tailwinds for many of these discretionary segments. So I don't think valuations will be cheap in this.
Okay, so learn to live with slightly elevated valuations. We'll take a break, come back on the other side. The conversation continues, and then we talk bread and butter, literally, staples. What place should they have in your portfolio in a post-COVID world? We'll discuss this with the experts. Welcome back. You are with the CNBC TV18 Investment Guide, and this week we are discussing the consumer sector. How should your portfolio be designed if you want to invest in the consumer space in the post-COVID world? Now, it becomes important to keep market psyche in mind as well. So, Sonam, which is why you mentioned for the discretionary part that valuations are elevated, and that's something we have to learn to live with. Now, I want to ask you the same question on staples. But let's also keep in mind that this is a market which is increasingly looking for ideas on economy-facing stocks, on power, on capex and things like that. So then would it still make sense to buy, a Lever or a Britannia, all of these stocks at 50, 60 times?
So actually it depends on your horizon. I agree. If you see the last 9 months, the market has broadened itself. And whether it's industrial capex, whether it's cap goods, whether it's commodities, utilities, all of them have made, investors have made a beeline for them. That being said, very few sectors in India have such a strong profitability mode, such a strong ROE, ROC as the FMCG sector. So in the short term, the weights might come off a little bit, based on allocation and trends. But any portfolio which wants to compound over the long term, I would find it very difficult for them not to have any FMCG stock in their portfolio. Very, very difficult, and it's very sticky. These are here. Once an EBITDA comes, it's very sticky. It's not that volatile. So you pay for that visibility and durability of earnings. To some extent in cycles, we have seen earlier as well, where valuations sort of come off a little bit when economy-facing stocks are doing well. But give it some time, it always normalizes.
Okay, fair enough. So that's a strong case for FMCG stocks despite the high multiples. Abneesh, come in on this. How much is still left on the table, so to speak, in the current market context? I go back to the point, the market right now is also looking at the capex side of things.
Yes, because of the budget tilt towards capex cycle and also HNI is playing a big role. The good thing is FMCG valuations are far more reasonable. So Hindustan Unilever, Nestle, etc. haven't really given a very good performance, which in a way is a good thing. Because of the pandemic, a lot of the cost structures have definitely been realigned, and there are a lot of cost savings which will continue because of the automation. Second is there have been big opportunities in the consumer demand, health aspect, and many new products have been launched by most companies. Plus, currently, Street is worried on the gross margin side. The good part is these companies have very strong pricing power. And if you see the commodity cycle, we haven't seen such a lengthened time period of high inflation. So my sense is second half, we could see margin expansion. First half, clearly most staples companies will see margin compression. But rural demand will come back. Wave 2 has derailed the rural demand. My sense is it will come back because of good monsoons and because of very good stimulus programs. We have got 5-6 key state elections. So our top picks in FMCG will be Godrej Consumer, and we also like Hindustan Unilever. HUL has underperformed because detergent and out of home have suffered because of wave 1, wave 2. Hopefully, those should see a structural comeback once we have the vaccines really picking up. Godrej Consumer, excellent company because of the new CEO who has been hired, Mr. Sitapati from HUL. So these are the two bets for us in the FMCG space.
Okay, let me ask you, Abneesh, in terms of the expected volume growth trajectory. The thing is that everything is so skewed over the last 1.5 years thanks to COVID. X of COVID, what is the sustainable volume run rate that you'll expect for some of these FMCG companies, the ones that are your top picks?
So this year will be a mix of price growth. In last 2 years, price growth for FMCG has been extremely low. So we will see most companies see 4 to 6% price hike across the company. On your question on volume growth, yes, Q1 will see impact on the rural side because wave 2 has been very widespread. So I will say taking that into account, still most companies should see a very good growth. Yes, base is also quite favorable because this time it was not a hard lockdown. But if I see the next 2-3 years, most of these topics should be able to grow at 7 to 8% volume growth easily. Plus, we'll have that 2 to 3% long-term pricing growth also. Plus, slight margin expansion, definitely because automation is possible. So we can look at a 12 to 13% EBITDA growth for these companies from a longer-term perspective. FY22 definitely has a low base, but yes, there is a gross margin pressure also to take into account.
Okay, got that point. Sonam, so let's start sort of rounding this up for our viewers. Among a lot of the points that you made, given the current landscape, given what you feel about the digital push in businesses, what sort of consumer businesses are you most optimistic on? I know you're not going to give us stock names, but at least some idea of the themes that you're looking at.
I've said it earlier, consumer appliances is one space which has a long road ahead of them. That space we like. Quarter on quarter, there may be variation, but over the next 5 years, it can compound money, essentially. On the online B2C space that we talked about, whether it's QSR, whether it's aggregators, whether it's financial marketplaces, even online ticketing, that is the space that we like. And any segment that is talking to the youth directly, that is also, we are very excited by that. We will continue to focus on our portfolios on these themes. We think this can compound materially over the next 5 years.
I have a feeling you will be watching out for the Paytm listing very, very carefully, given everything that you say, Sonam. But that's on a lighter note. On a serious note, are you expecting anything more from the unlisted space, the fresh issues that perhaps might come through the next 1 year, where there could be something interesting from the consumer perspective?
So I think these names are pretty well known. I mean, there is an impending Zomato that is there. You talked about Paytm. There are other online. Why only consumer? There is, say, for example, a Policy Bazaar, which is not strictly consumer, but it is talking to the consumer and servicing consumer on the insurance side. Valuations are separate, and we'll take a call there. But those are exciting spaces to sort of look at. That's a growth area that we would look at positively.
Okay. Abneesh, I mentioned you I heard you mention some of your top picks, and there's Titan and there is Lever. From what you said, there's Godrej Consumer. From what you said, it's basically a return to the knitting, basically. The old czars, will they continue to rule, or do you see new stars on the horizon as well?
I think in terms of valuation comfort, Bajaj Consumer is looking interesting, inexpensive valuation, and they also had a turnaround CEO from Asian Paints. So that is looking interesting. Yes, near term, there is a gross margin pressure because of LLP, but that will give them opportunity to gain market share. So in the smaller names, I think Bajaj Consumer definitely is looking really interesting. They have addressed most of the promoter concerns. Pledging is down to zero. They have gone back to the dividend, almost 10 rupee dividend they have paid out for the year. So that's looking really interesting in the valuation comfort small cap zone.
Okay, now, gentlemen, final thoughts. We've come to the agreement that you can't judge a consumer stock purely by looking at the price to earnings multiple, right? So, Abneesh, you tell us what would be the 2 or 3 most important criteria parameters for you when you are deciding whether this is a stock that you like or not.
I think in consumption, market share gain is extremely important. Second would be what are you doing in terms of disruption, as Sonam also rightfully highlighted in terms of e-commerce and omni and direct to consumption. That is very important. And third would be what are you doing intrinsic to the company in terms of automation and robotics and all that. So I think these 3 are the most important. Fourth, of course, is innovation. So these 4 would be the most important parameters to judge any consumption company, not necessarily FMCG. It could be from any consumption vertical.
Got that. So in the post-COVID world, please do not only look at the price to earnings multiple. Sonam, your thoughts on this and your key filters that you will run these companies by?
So I think market dominance is something that we look at, whether that will continue or not. Ultimately, it is very well known fact that almost 80% of a segment's profitability is owned by the top 3 companies, and if you can dominate that, then it gives you some amount of visibility, and for that visibility, higher valuations therefore can be justified. And that is one. Ability to generate return ratios, and how fast, how far, how much you are innovating, and how much you are talking to the young consumer. India is a young country. If you focus on that, I think your future is secure. That's how I would look at it.
Okay, and that's a lot of food for thought, shall we say. Gentlemen, thank you very much. It's been a pleasure talking to you and getting your inputs on the consumer sector and the way to approach it in the post-COVID world. Many thanks for watching. That's going to be a wrap on this week's edition of the CNBC TV18 Investment Guide. We'll see you next week with another theme.